Welcome to the Pro Ticker Deep Dive. We're diving straight into Tokyo today because, well, Japanese equities have been such a huge story this past year, but they just hit a snag, a pretty sharp 4-day losing streak. So the big question, and really our mission for this deep dive, is pretty simple. Is this just a blip? A healthy correction before things take off again? Or could this be an early warning, a sign that maybe global sentiment towards stocks is starting to shift?
Yeah, the speed of it is what catches your eye, isn't it? Especially after months of, well, just huge enthusiasm. I mean, remember what was driving that is this really potent mix. Corporate reforms picking up steam, earnings holding up surprisingly well, and of course, massive foreign money pouring in, largely thanks to that weak yen. But you can feel it now. That momentum has definitely cooled off fast. The Nikkei 225, it's pulled back quite a bit. Traders are reassessing global risk, seems like, especially with everything going on with central banks and the strong dollar.
Okay, so let's unpack that a bit. What are the big macro forces, the external pressures, really causing this sharp turn away from Tokyo right now?
Well, it really starts with the U.S. economy. It
Yeah.
just keeps surprising everyone with its strength. That strength is pushing U.S. Treasury yields higher, which pulls the dollar up with it. And
Oh,
honestly, that acts like a magnet, pulling capital back into dollar assets. It puts pressure on pretty much all Asian markets. And then you layer Japan's unique situation on top. I mean, after decades fighting deflation, they finally have some inflation. So the Bank of Japan is taking these tiny first steps towards normalizing policy, moving away from that zero interest rate world. But that creates this real mismatch, right? Because most other developed countries are talking about cutting rates or planning to. That policy difference, it just breeds volatility for Japanese assets.
yeah, and that brings us right back to the yen, doesn't it? That double-edged sword. I mean, its weakness down near those multi-decade lows, that was the big draw initially. Huge for exporters, pulled in tons of global money.
Exactly. It was the main story for a while. But the flip side is now that weakness is starting to hurt. It's painful for companies bringing stuff in, consumers too, with rising import costs, think energy, raw materials. So that initial excitement from global investors, it's definitely cooled, especially as, the costs to hedge that currency risk start to add up for foreign funds. That big tailwind we saw boosting performance earlier this year, it's losing puff, no doubt.
Okay, let's switch gears a bit. Let's look at the market mechanics. Because while the U.S. markets, the S&P, the Nasdaq, they've been pushed higher by all the AI excitement, Japan is clearly lagging behind now. So what's happening under the surface? What are the specific dynamics driving this slide?
Well, it looks like classic risk-off behavior. You can see it really clearly in the sector rotation. The defensive stuff, utilities, energy, they're holding up surprisingly okay. But the cyclicals, the parts of the market that really depend on the global economy doing well, tech, machinery, the big exporters, they're leading the way down. That tells you investors are basically trimming their bets on global growth, particularly across Asia. There are renewed worries about China's growth path, maybe some commodity price jitters too. And meanwhile, that U.S. strength, fueled by AI hopes and strong consumer spending, it's acting like this huge vacuum, pulling capital away from areas seen as maybe a bit riskier right now.
And the flow data, the money moving in and out, that backs up this nervousness.
Oh, absolutely. The flow numbers are stark. We've seen net selling from foreign investors over the past couple of weeks, which is a complete U-turn from the steady buying we saw earlier in the third quarter. And what makes the moves even sharper is that local Japanese institutions, well, they haven't really stepped in to buy the dip. Not yet, anyway. So you get this really thin liquidity, which means even small shifts in sentiment can cause these much bigger, more volatile price swings day to day.
Right, but okay. Despite all the near-term jitters and this cautious mood, we shouldn't forget the underlying value, should we? Valuations still look pretty attractive compared to elsewhere.
That's a key point. Japan's forward price-to-earnings ratio, basically what you pay for expected future profits, is still around 14 times. Compare that to the U.S. market at maybe 20 times or even higher. You're just paying significantly less for potential growth in Japan. And that discount, it really points towards the longer-term structural story. If you zoom out a bit, look, the fundamental positive case for Japan hasn't really gone away, even with these short-term headwinds blowing. There are still, I'd say, three big ongoing tailwinds. First, reform momentum. Those corporate governance changes are still happening. The Tokyo Stock Exchange is keeping the pressure on companies to use their capital better. And that means more share buybacks, better dividends down the line. That's real. Second, global diversification. With the yen still historically quite weak, Japanese stocks offer, well, a pretty appealing hedge if your portfolio is maybe too heavy on the US dollar. And third, you can still find selective bargains. Some really high-quality companies, industrials, automation specialists, chip equipment makers with global reach, they look quite cheap compared to their international peers right now.
Okay, that's the compelling long view. But let's bring it back to the immediate picture. What are the specific hurdles, the crosswinds hitting Japanese stocks right now that could, turn this pullback into something worse?
Yeah, the immediate risks. Well, the big one globally is that U.S. yield shock potential. If U.S. interest rates keep climbing higher than expected, that puts even more pressure on the yen, and it could easily trigger more, maybe even faster foreign selling. Domestically, there's the consumption drag. Rising import costs hit businesses, sure, but wages aren't really keeping pace, so consumers might struggle to afford higher prices here at home, and that could undermine that crucial domestic recovery. And then you always have to factor in geopolitical noise in the region, or maybe the Bank of Japan makes a misstep as it tries to navigate this very tricky policy normalization. Sentiment can shift fast on those things.
Right, makes sense. Let's get technical for a moment. For the traders tuning in, what are the charts telling us? What are the key technical signals about the Nikkei 225 right now?
Okay, yeah, from a pure trading standpoint, the setup looks a bit fragile, honestly. You can clearly see the loss of momentum after the index failed to hold above that 39,000 level. Right now, it's pulled back towards its 50-day moving average. That's often a key psychological and technical support area traders watch. We're looking at minor support around the 38,000 mark, but the really critical level, kind of the line in the sand, seems to be near 37,200.
And you mentioned volume earlier. Are there any red flags there in terms of trading patterns?
Yes, the volume patterns are a bit worrying. They suggest what traders call distribution. What that means is, on days when the market rallies, the trading volume is kind of light, not much conviction. But on the down days when the market falls, the volume is heavy. That's often seen as a bearish signal that suggests bigger players might be selling into strength or unloading positions, money moving out, essentially. Also, something like the RSI, the Relative Strength Index, which measures momentum. It has come down from being overbought, but it's not yet oversold. So, technically speaking, there might still be room for prices to fall further before you see those real bargain hunters, the institutional dip buyers, feel comfortable stepping back in a big way.
Okay, so boiling that down for actionable levels, keep an eye on that 37,000 to 37,500 zone for potential support, maybe a bounce. But be cautious, a clean break below 36,800 could signal a much deeper correction is underway. On the flip side, to feel confident the momentum is back, you'd really need to see a sustained move back above 38,800.
Exactly. So, I think the final takeaway here is this. This 4-day slump in Japan is probably best seen as a recalibration, not a fundamental disaster. The market had a fantastic run, huge inflows came in. Now it's just digesting those gains, especially while these global macro factors temporarily make, say, U.S. tech look more attractive.
Yeah, I agree. The core reasons to be interested in Japan, the corporate reforms really taking hold, those attractive valuations compared to elsewhere, their leadership in key global manufacturing areas, that fundamental story hasn't changed. This near-term wobble, it might just be the market catching its breath, resetting things a bit before potentially moving higher again. So the thought to leave you with is stay watchful, definitely, but maybe not fearful. Could this necessary pullback actually be setting the stage for Japan's next leg higher? See you all in the next Pro Ticker Deep Dive.